Before you scroll, before you click away, before you check that other tab you definitely still have open, pause for just a moment. I want your full attention, because what I'm about to explain is not market noise, not internet drama, and not another exaggerated commodity headline. This is one of those rare moments where the plumbing of the global financial system creaks loudly enough that even retail investors can hear it. Right now, the price of silver you see quoted on your screen is not telling you the truth. It's not malicious in the cartoon villain sense, but it is deeply disconnected from reality. The number flashing on your trading app is generated by a paper market thousands of miles away from the factories, vaults, and buyers who actually need physical metal. And today, that disconnect crossed a line that should make anyone paying attention sit up straight. In the United States, silver is trading around $85 an ounce. Depending on when you check, it might be a little higher or a little lower, but that's the neighborhood. Meanwhile, in Shanghai, buyers just closed the afternoon session paying $93.31 per ounce for physical silver. Not futures, not promises, not we'll deliver later if everything goes well. Real bars, real metal, real settlement. Let that sink in. An $8.31 gap on a fungible global commodity. In a healthy, functioning market, that kind of spread is a rounding error that lasts minutes. Arbitrage desks exist for one reason, to erase those gaps. Buy low in one market, sell high in another, move the metal, pocket the difference, repeat until prices converge. That's how global price discovery is supposed to work. And yet, here we are, watching a gap that didn't close in minutes, didn't close in hours, didn't even narrow over weeks. It widened. 2 weeks ago, the difference between East and West was roughly $5. Last week, it was closer to $7. Today, it pushed past $8. That is not stabilization. That is acceleration. To understand why this matters, you need to understand what happened in China today. The Shanghai Futures Exchange trades silver in 2 daily sessions. The morning session already raised eyebrows, closing around 91.13 per ounce. That alone represented a significant premium over Western prices, but we've seen elevated premiums before, especially during periods of regional demand. It was notable, not shocking. Then the afternoon session opened and something changed. Buyers didn't nibble. They didn't test levels. They overwhelmed the order book. This wasn't retail speculation or short-term momentum chasing. This was industrial demand, procurement orders, and strategic buying. The kind of buying that doesn't tee up preempta, care about charts or RSI indicators because the metal is needed, period. By the time the session closed, silver had ripped to 93.31ers. A $2 plus move in a single afternoon session is not normal for a physical metal. That's the kind of move you associate with currencies under stress or bond markets losing credibility. It signals urgency. It signals scarcity. It signals buyers who are no longer negotiating. Now compare that to what happened in the United States. The COMEX spot price drifted, flickered, did what paper prices do, and settled somewhere around $85. The exact number almost doesn't matter. What matters is that the U.S. market is trading at least $8 below where real metal is clearing in China. That is not a premium. That is not a spread. That is a structural failure. When two prices for the same asset diverge this far, it means price discovery is no longer unified. We are no longer dealing with one global silver market. We are dealing with two separate systems that no longer talk to each other. One trades contracts, the other trades metal, and the most important detail is this. The gap isn't narrowing, it's expanding. That tells you demand pressure is not being relieved. Chinese buyers are not waiting for Western prices to catch up. They are front-running what they believe is inevitable. They are paying whatever is required to secure supply now because they do not trust future availability. Why would anyone pay $93 when the so-called spot price is $85? Because the spot price represents a paper claim. It's the price of a contract that might deliver metal later, assuming the system holds together. The Shanghai price is the price of silver you can load onto a truck today and feed directly into a production line. When supply chains are stressed and inventories are thin, that distinction becomes everything. This is not a rally, this is a repricing. It's the market discovering in real time what scarce physical silver is worth when buyers actually need it and can't rely on promises. So why hasn't arbitrage closed the gap? Why aren't banks buying silver in New York, shipping it to Shanghai, and locking in risk-free profits? On paper, it looks like the easiest trade in the world. The answer is simple and it's uncomfortable. There is no silver to move. Arbitrage requires two conditions. First, price divergence. Clearly, we have that. Second, available supply. You need to be able to source physical metal in the cheaper market. And that's where the system breaks. When banks try to stand for delivery on COMEX, when they try to pull bars from registered inventory, when they call dealers looking for size, they run into the same problem. The metal isn't there. Registered inventory has dwindled to roughly 30 million ounces. That sounds substantial until you compare it to open interest representing hundreds of millions of ounces in paper claims. The math doesn't work, and it hasn't for a while. The smart money noticed. They removed metal months ago. What's left is spoken for, pledged, or functionally unavailable. Even if a bank could source silver in the US, another barrier stands in the way: China's export licensing system. Once metal enters China, it does not leave. The government has effectively installed a one-way valve. Silver can flow in, but it cannot flow back out. That alone kills traditional arbitrage. You're not just moving metal across oceans anymore, you're permanently removing it from the Western supply pool. So the bridge between East and West isn't damaged, it's gone. What we're witnessing is a true market bifurcation. Two prices, two realities, two systems operating under completely different constraints. And if you're sitting in the US thinking, this is an interesting overseas story but doesn't affect you, that's where the mistake happens. China is not the outlier here. It's the leading indicator. It's the canary in the coal mine, and the canary didn't just cough. It stopped singing. When Chinese buyers pay $90 while Western markets quote $85, it tells you the paper price is wrong, not slightly off, structurally wrong. Eventually, paper markets are forced to reconcile with physical reality. They can do it gently, or they can do it violently. History suggests it's usually the latter. That reconciliation can take many forms: delivery failures, force majeure clauses, cash settlement mandates, or outright defaults. The mechanism matters less than the outcome. The paper price gaps upward to meet the physical price. And when that happens, it won't be a slow, polite adjustment. It will be an overnight repricing. Silver won't drift from $85 to $93. It will open at $95, $100, or higher, because once confidence in paper settlement evaporates, price becomes whatever the marginal buyer is willing to pay. So the Shanghai price today isn't just a data point. It's a preview, a warning shot, a glimpse of what happens when the illusion of abundance collapses and only real metal counts. This isn't about hype. It's about structure. And today, that structure cracked loudly enough that no one paying attention can pretend they didn't hear it. What you're seeing right now isn't just a chart pattern or a lucky guess about where prices might go next. It's closer to a forecast that's already in motion, a roadmap that's showing you, in fairly blunt terms, where the US silver price is headed and how little time there may be to get positioned before the window closes. And the Shanghai price we talked about earlier? That's only one piece of this picture. An important one, yes, but not the whole story. While the Chinese market was going vertical, I was doing something else at the same time. I was on the phone, calling people who live and breathe physical silver here in the United States, people who don't talk in theories or charts, but in inventory sheets, delivery schedules, and uncomfortable conversations with customers. What they told me should make anyone who owns dollars and not metal pause. I spoke with executives at major bullion dealers. These are not corner coin shops or online hobby sellers. These are the largest dealers in the country, the ones that supply the retail market at scale, the ones with direct relationships with mints and refineries. And the message was shockingly consistent. One of them said it flat out, no hesitation, no drama. Nobody has any silver. Those were his exact words. Nobody. The premiums told the same story. Just last week, you could still find physical silver at around $5 over spot if you looked hard enough. Today, that number has jumped to $8 or $9, and that's not the final price. That's the opening bid. From there, it's a negotiation, assuming there's even inventory to negotiate over. One executive told me something that would have sounded ridiculous a year ago, but today it sounded disturbingly logical. He said silver round premiums could easily reach $20 to $30 per ounce. Not total price, premium, on top of spot. Do the math. On an $85 paper price, that puts your real cost at $105 to $115 per ounce. And he wasn't speculating. He wasn't trying to scare anyone. He was reading off what his inventory and order backlog were already telling him. Here's the reality behind that math. The private mints that produce silver rounds and bars for the retail market are completely overwhelmed. The volume of orders they've seen over the last 2 weeks exceeds what they experienced during the 2020 silver squeeze. And back then, they managed to ramp production, source raw material, and catch up within a few months. This time, that safety valve doesn't exist. The problem isn't capacity, it's supply. The refineries are not selling the metal. Refineries are prioritizing long-term industrial contracts. Solar manufacturers, electronics giants, EV producers, these buyers don't haggle over premiums and they don't accept delays. They get first call on available silver. The mints that serve retail investors are at the back of the line. As a result, delivery times are exploding. If you place an order with a private mint today, you're looking at an 8-week wait, 2 months. And that's the optimistic scenario. That assumes the mint can actually source the silver it needs and doesn't IT have to refund your order because supply dries up entirely. Let that sink in. You pay today, wait 2 months, and hope the system still works. So if you want physical silver right now, you're faced with two options. Option 1, Buy from a dealer with inventory and pay a premium that feels borderline offensive. Option 2, place an order, wait weeks, and gamble that nothing breaks in the meantime. Neither option is attractive, but the second one isn't really investing. It's betting that the market stays calm long enough for your order to arrive. And there's another risk people aren't talking about. What happens if silver reprices violently while you're waiting? If the spot price gaps to $120 or $150 before your metal ships, your locked-in price becomes meaningless in real terms. You didn't avoid risk, you just delayed it. This is why premiums are no longer optional. They are the price of admission. The number on your screen is a theoretical reference point. The number you actually pay to get metal in your hands is already flirting with triple digits. That's not manipulation. That's supply and demand doing what it always does when supply disappears, which leads us to a truth most investors are deeply uncomfortable with. The price you see quoted on TV is not the price of silver. It's the price of a derivative of silver, a futures contract, an ETF share, a paper promise, and when you try to turn that promise into something tangible, you discover the exchange rate is broken. Paper says $85, metal says $100, and that gap is widening, not shrinking. Why are premiums exploding? Because dealers aren't clueless. They see the same data. They see Shanghai. They see inventory draining. They see delivery failures stacking up. And they understand something critical. The silver in their vault today will almost certainly be worth more next month. So why sell it cheaply now? They're rationing supply. They're pricing in the future. They're waiting for the paper market to admit what the physical market already knows. When that admission comes, the dealers who held inventory will look brilliant. They'll sell at $120 or $150 and be called lucky, even though there was nothing lucky about it. They read the signals. The investors who waited for a dip, who trusted the spot price, who thought silver would pull back to $75 so they could buy comfortably, are going to discover there's nothing left to buy. This is the supply shock people have been warning about, and it's not theoretical anymore. It's not a next year problem or a someday scenario. It's happening now. Now zoom out for a moment, because silver isn't acting alone. Gold just hit an all-time high, somewhere north of $4,600 per ounce. That's not a casual breakout. That's gold screaming that something is fundamentally wrong. When gold and silver both surge like this at the same time, it's not coincidence, and it's not just a commodity rally. It's a vote of no confidence in the system backing fiat currencies. And here's the part most people miss. When gold and silver go vertical, they don't just compete with stocks for capital. They create a liquidity vacuum. The global financial system is built on the idea of a risk-free asset, and that role is played by U.S. treasuries. Everything is priced off them. Stocks, bonds, real estate, everything. But when gold is up 30% and silver is up 170% while treasuries are losing value, that foundation cracks. Investors start asking uncomfortable questions. Why hold a risk-free asset that yields 4%, but loses principal, when an asset that yields nothing is compounding faster than almost anything else? So they sell bonds. Treasury prices fall. Yields rise. Borrowing costs increase. Spending slows. At the same time, stock valuations break. Higher yields mean higher discount rates. Higher discount rates mean lower present values. Even if earnings don't change, prices have to adjust downward. This is why precious metals going vertical is dangerous for equities. It doesn't just siphon money away. It undermines the math that justifies current valuations. We've seen this movie before. In 2000, in 2007, in 2019. Each time gold and silver surged, treasuries weakened, and within months the economy hit a wall. Dot-com crash, housing collapse, repo crisis, and then COVID. Now it's 2026, and the signals are lining up again. And looming over all of this is the Federal Reserve. As this was unfolding, news broke of a criminal probe involving Jerome Powell. I'm not speculating on guilt or outcomes. That's not the point. The point is credibility. The head of the world, the most important central bank under investigation, at the exact moment the financial system is under strain, is not reassuring. Confidence is fragile, and once it cracks, it doesn't come back easily. The market is telling you something. The question is whether you're listening. Once confidence in a central bank cracks, events stop moving in slow motion. Things accelerate, narratives collapse, and outcomes that once seemed unthinkable suddenly become unavoidable. That's the phase we're entering now, and it puts the Federal Reserve, and Jerome Powell personally, into a corner with no clean exit. There are only two doors left, and neither of them leads to a pleasant outcome. The first option is the familiar one. Print, cut rates, restart quantitative easing, flood the system with liquidity to stop asset prices from collapsing and to keep banks and markets functioning. In the short term, this works. Stocks stabilize, credit markets breathe again, headlines calm down, but the cost is paid elsewhere. The currency absorbs the damage. Inflation accelerates, purchasing power erodes, and confidence in the dollar takes another major hit. Hard assets respond immediately. Gold doesn't politely rise, it explodes. Silver doesn't inch higher, it launches. If the Fed chooses this path, silver doesn't stall at $100. It moves to $150, $200, maybe beyond, because every newly printed dollar cheapens what already exists. The second option is the one central bankers talk about but rarely tolerate. Hold rates high, stop printing, let bad debts fail. Allow zombie companies to go bankrupt, let housing reprice, restore discipline. In theory, this cleanses the system and lays the groundwork for a healthier future. In practice, it triggers a brutal contraction. Stocks crash, credit freezes, unemployment surges, banks fail, politicians panic. And while silver might dip briefly in the initial deflationary shock, it doesn't stay down. Once the dust settles, the loss of institutional credibility drives capital straight back into hard assets. The dollar survives in name only, and silver reasserts itself as a store of value in a system people no longer trust. That's the trap. Print and destroy the currency. Don't print and destroy the economy. The Fed can't win, and the market knows it. Investors see the investigation swirling around Powell. They see policy paralysis. They see a central bank boxed in by its own past decisions. And they responding the only way markets ever respond to a loss of confidence, by leaving out of dollars, out of treasuries, into gold, into silver. This is the confidence crisis that's been quietly building, and now it's speeding up. For silver specifically, the implications are clear. If the Fed prints, silver wins through currency debasement. If the Fed doesn't print, silver wins through safe haven demand layered on top of an industrial supply shortage. Different paths, same destination. That's why silver right now is one of the most asymmetric trades available. You're not betting on a single scenario. You're positioning for a range of outcomes that all point higher. The only world where silver meaningfully loses is a fantasy scenario where the Fed executes a flawless soft landing. Inflation magically disappears, growth stabilizes, confidence returns, and, just to make it extra unlikely, a wave of new silver mines comes online and floods the market with supply. That combination borders on science fiction. Realistically, the downside is limited, maybe a 10-15% pullback during a panic. The upside is multiples of that. A 100% move isn't aggressive in this environment. That's what asymmetric looks like. And asymmetric opportunities don't wait patiently. The problem is timing. The window to act is closing fast. 2 weeks ago, silver traded at $75. Last week, $80 with manageable premiums. Today, you're looking at $85 spot plus 8 on ARG or $9 just to get your hands on metal. That puts you in the mid-90s all in. Next week, premiums could be $15. The week after that, dealers may simply say, we're out. This is the escalator effect. Prices don't move smoothly upward. They step higher, pause, then step again. And every pause tempts people to wait for a pullback that never arrives. Hesitate long enough, and you realize the escalator has carried everyone else 10 floors above you. If you're still waiting for the perfect entry, here's the honest truth. Perfect was 2 years ago at 20, good was 6 months ago at 30. Acceptable was 2 weeks ago at 75. Today, $93 or $94 all in is still reasonable if you believe the thesis, but it's not generous, and it gets worse by the day. So the real question isn't whether silver is expensive today. The question is whether you believe silver trades at $150 or $200 in the not-too-distant future. If you do, then paying $94 now is effectively buying at a discount to where it's going. If you don't act, you may end up watching silver hit triple digits while telling yourself you were waiting for confirmation. Let's talk about how to actually position, because the playbook that worked 6 months ago is outdated. Back then, buying a silver ETF like SLV felt reasonable. It tracked price, it was liquid, and it gave you exposure without storage headaches. Today, that convenience comes with risk. SLV is supposedly backed by physical silver held by JP Morgan. The issue isn't whether JP Morgan owns silver. We know they do, hundreds of millions of ounces. The issue is transparency and priority. We don't at know how much of that silver is truly allocated to ETF holders versus internal use. And more importantly, the SLV prospectus allows for cash settlement during market disruptions. Translation: if the system breaks, you may get dollars instead of metal. And dollars won, help much if silver is trading at $150 and you recashed out at $85. That's not exposure. That's counterparty risk. A better alternative is PSLV, the Sprott Physical Silver Trust. It's domiciled in Canada, stores metal at the Royal Canadian Mint, has more transparent audits, and allows physical redemption above certain thresholds. Is it perfect? No, but it's meaningfully closer to actual ownership than SLV. The gold standard, of course, is physical silver you control. Coins, bars, rounds, metal you can hold, store, and verify. Yes, there are premiums. Yes, there's storage and security to think about. But ownership matters when paper systems strain. Convenience is great until it isn't. And when things break, convenience is usually the first casualty. If you can buy physical, pay the premium, accept the inconvenience. It's a small price compared to the risk of not having access at all later. If premiums make that impossible, PSLV is a defensive compromise. What you don't want is to sit in cash, treasuries, or money market funds earning a few percent, while confidence drains from the system beneath you. The Shanghai price, 93.31, isn't noise. It's a signal. It's the physical market speaking louder than the paper one. And that gap between the two isn't closing, it's widening. People always ask for timelines. When does comics break? When does silver hit $150? No one has a crystal ball. But the indicators are lining up quickly. January delivery notices are coming. If a surge in contracts stands for delivery, panic will follow. The realization that there isn't enough metal to meet obligations will spread fast. When that happens, prices won't creep higher. They'll gap. It wouldn't take much to see silver open 10 or 15 higher in a single session. A weekend headline, a failed delivery, a sudden rule change. Markets don't need permission to reprice. They just need a catalyst. And once that repricing starts, physical premiums will explode again. Dealers will go no offer. Mints will stop accepting orders. The retail market will effectively shut down. At that point, owning silver won't be about buying. It will be about already having. This isn't meant to be dramatic. It's meant to be realistic. Every major financial rupture looks obvious in hindsight and unbelievable in real time. This is one of those moments. A Lehman-style event, not in banking, but in commodities. And unlike banks, the Fed can't print its way out of a physical shortage. You can create dollars. You can't create silver. The Shanghai price is the smoking gun, proof that arbitrage is dead, proof that the paper and physical markets have split into separate realities. One is anchored in contracts and assumptions. The other is anchored in supply and demand. And reality always wins. So step out of the fantasy, step away from promises that may not be honored. Choose ownership over convenience. Because when this system finishes breaking, and it's already cracking, the winners want to be the ones with the best charts or the fastest trades. They'll be the ones holding something real. The gap is $8 today. It won't stay there. How wide does it need to get before the message is clear?